Welcome back. Today, in episode 11 of our Explainer series, we are diving into a really fascinating evolution in financial engineering, indexes and volatility as an asset class. We're going to journey from the ground floor of basic index mechanics all the way up to trading volatility. And we're not just looking at it as some passive fear gauge. No, we're treating it as a distinct, yield-generating asset class with its own term structure. Let's look at exactly how institutions strip apart the market to trade pure variance.
Here is our roadmap for this explainer. First, we'll cover index arbitrage and vol targeting. Second, dispersion trading and PCA models. Third, trading the VIX term structure. And finally, vol premia and variance swaps. Let's get right into it.
Part 1, Index Arbitrage and Vol Targeting.
To start, we really have to look at how spot prices and futures are linked. The no arbitrage futures formula mathematically locks the current spot price and the futures price together. In plain English, the fair price of a futures contract has to equal the current spot price of the index minus any discounted dividends paid before expiration and then compounded at the risk-free rate. That accounts for your cost of carry. Now, the basis is simply that mathematical link. It's the difference between the actual market price and this theoretical fair price, divided by the spot price. It tells you exactly how far out of whack the market is.
So, what do we actually do with that basis? Well, if the basis is greater than 0, the futures are pricing rich compared to the spot. So your play is to short the futures and go long the underlying cash basket. If the basis is less than 0, the futures are cheap, so you just reverse it. Buy the futures, short the cash basket. Pretty straightforward, right? But here's the reality check. These arbitrage windows are incredibly short-lived. High-frequency trading speed is literally the ultimate gating factor here. If your execution infrastructure isn't lightning fast, transaction costs and slippage will completely devour your profits before your trade even clears.
Moving beyond split-second arbitrage, what if we want to hold the index but strictly control our risk over time? Enter volatility targeting. Instead of keeping a static allocation, we dynamically adjust our capital. We calculate our target weight in the index simply by taking our target volatility and dividing it by the index's current volatility. Whatever capital is left over just sits in a riskless asset like T-bills. But we definitely don't want to rebalance every single day. That just leads to massive overtrading and fee drag. Instead, we use a rebalance trigger, a mathematical threshold called kappa, so we only trade when our allocation actually drifts past a certain boundary.
Okay, moving on to part 2, dispersion trading and PCA models. We're going to break the index apart.
Here is the absolute core inefficiency that dispersion traders exploit. Mathematically, the theoretical variance of an index is simply the sum of its constituent stocks' variances, weighted by their size and, crucially, multiplied by their sample correlation. But here's the secret the market gives us. Empirically, the implied volatility priced into index options is almost always higher than this theoretical, bottom-up calculation. The index options are essentially overpriced relative to the individual parts that make up the index. To extract that mispricing, we set up a classic dispersion trade. On one side, we go long on single-stock straddles for the components of the index. On the other side, we short an index straddle. But you have to be highly precise here. You can't just buy equal dollar amounts of everything. The weighting of your single-stock straddles has to be precision-engineered based on shares outstanding in the index level. This ensures your long portfolio perfectly matches the payoff profile of your short index position.
But think about this. What if you're trading the S&P 500 and some of the smaller components have super illiquid options? You can't efficiently trade all 500 names. This is where the strategy gets an upgrade to subset dispersion. Step 1, we throw out that basic sample correlation matrix and replace it with a principal component analysis, or PCA, statistical risk model. Step 2, we extract the top K principal components to explain the systematic risk of the market. Step 3, we select a subset, maybe just 100 stocks out of the 500, that have the lowest specific risk-weighted variance. By doing this, we've mathematically isolated the absolute best components to trade, minimizing the chance of idiosyncratic blowups.
Part 3, trading the VIX term structure. Now we're looking at pure volatility. When you step into trading volatility products, you must understand the VIX futures basis. It's the price of the first month VIX futures contract minus the spot VIX. And even more importantly, you need to track the daily roll, which we'll call D. You calculate D by dividing that basis by the time to settlement. Why does this matter to us? Because empirical data shows that the VIX futures basis has massive forecasting power for mean reversion dynamics. Not necessarily for forecasting the VIX itself, but for predicting the future price changes of the futures contracts. Armed with that daily roll calculation, we can establish crystal clear mean reversion rules. If the daily roll is greater than 0.10, the curve is in steep contango. The futures are overpriced relative to spot, so we short the front-month contract. If it's less than negative 0.10, we have steep backwardation, so we buy the contract expecting it to rise. But listen very closely here. A short VIX position can absolutely ruin you in a sudden equity market crash. Because of that, we have to rigidly hedge the directional equity risk by taking opposing positions in many S&P 500 futures. You can't skip that step.
This dynamic leads us to a fascinating trade using exchange-traded notes, or ETNs. Take a product like VXX, which constantly buys short maturity VIX futures. Because the VIX term structure is usually in contango, VXX suffers brutal roll loss, or contango decay, as it constantly replaces expiring futures with more expensive ones. Now contrast that with VXZ, which holds 4 to 7 month maturities, meaning its roll decay is significantly milder. So, what's the classic volatility carry trade here? You short the rapidly decaying VXX, and you hedge your tail risk by going long VXZ, continuously adjusting the ratio using a serial regression.
Finally, Part 4, Vol Premia and Variance Swaps. This is where we graduate to institutional-level trading.
The big goal here is capturing the volatility risk premium. Similar to our dispersion trade earlier, this strategy exploits that empirical wedge between higher implied volatility and lower realized volatility. We do this by continuously selling at-the-money index straddles. But remember, we don't want to bet on market direction. So we meticulously apply gamma hedging to adjust our underlying stock positions, keeping the entire portfolio delta neutral. By neutralizing the directional movement, we turn the position into a pure theta play. We are literally getting paid for the passage of time as those overpriced options decay.
But let me pause right here and pose a question direct to you. If selling options works so well, why did the financial industry invent variance swaps? I mean, why not just trade straddles all day?
Well, the answer lies in the harsh realities of market mechanics. First off, continuous delta hedging of an options book is highly impractical. The market is always moving, and you can't realistically hedge every single second. Second, the friction of all those transaction costs heavily erodes the profit margins of a straddle. Third, options have path dependency. The exact sequence of price movements up and down really matters. Variance swaps were designed to bypass all of this friction. They are sleek, direct instruments that capture the pure difference between realized and implied variance. And you don't need to buy a single share of underlying stock to hedge.
And here is the elegant mathematics behind it. The variance swap payoff is simply the variance notional amount, multiplied by the difference between the actual realized variance at maturity and the variance strike price agreed upon at the start of the contract. It's just a pure, frictionless bet on volatility. In fact, institutional traders will often rebuild the entire dispersion strategy we discussed earlier by simply selling a variance swap on the index and buying variance swaps on the individual components. No straddles, no delta hedging. It is truly the ultimate evolution of the trade.
Which brings us to our concluding thought for today. Volatility has fundamentally transformed over the years. It is no longer just a passive fear gauge or some secondary metric we use to measure equity risk. Through arbitrage, term structures, and variance swaps, volatility has become a distinct, yield-generating asset class, entirely governed by its own mathematical laws and mean reversion dynamics. So the question is, now that you understand the underlying mechanics of variance, how will you look at market turbulence tomorrow? Thank you for joining me for this explainer. I really hope this deep dive has completely reshaped how you view the architecture of financial markets.